I had a little tongue-in-cheek title to the live stream I did a couple of days ago that said they're lying to us. And the reason I said that was something just doesn't quite seem to be adding up with what I'm seeing on the shop floor and certain stats versus the rhetoric that's coming out of the policymakers' mouths. Okay, so it entertained me no end to see this tweet just now with Sunak today saying the economy is growing, with the ONS today saying GDP fell 0.3% in October. And if I'm honest, I think that probably sums the whole thing up in terms of where we are right now. So good evening, everybody. If you're on the live stream, welcome to this evening. It's going to be a quick one. I want to talk about the report today on October's GDP figures with a surprise drop in GDP that nobody was expecting. So we're going to look into that report, see where that's come from. Specifically, I want to relate it to the bigger picture, what this is going to drive over the next, however many months. We're talking about interest rates a lot. How is that then going to feed in to the housing market? As always, team, we are here to talk about the actual data behind the headlines, or when we get through the headlines, so we can make more informed decisions. And welcome to everybody who's new to the channel. I know there are lots of people at the moment, which is fantastic. As we go through, I said I do not want to be much more than 10 to 15 minutes this evening. Please have your comments as we go through, and we'll have a little chat afterwards, as always. First of all, if you can hear me and see me, give me a thumbs up. I can see we have things in the comments. So Mark, good evening. Stafford, good evening. If you're watching on the replay, please also put your comments in so we can discuss. So let's have a look. We'll go through the report in a sec, but let's have a look at some of the reaction, the immediate reaction from today's apparent shock drop in GDP. So all of a sudden, what we've been talking about for weeks actually, and if you were on Monday's session, was it Monday? Sorry, it was last week, wasn't it? If you're on last week's session, we talked about some of the private sector reports that were showing the jobs market and what looked like to be a major softening of the jobs market, and also a lot of anecdotal, sorry, I can't even speak this evening, discussion about what we're seeing on the shop floor in terms of things like property price reductions, in terms of business, in terms of, what's out there. Yet the policymakers have been saying we're going to avoid recession. If you remember last month, Bailey said we're now 50-50 recession. And there's a lot of headlines now flashing recession is on its way. And we'll look through the actual figures in a second. What has happened with that? Well, all of a sudden people have gone bananas, and the traders in the markets are expecting massive capitulation in interest rates into 2024. So we've still got this push-pull between the bank and the central banks, MPC, talking about interest rates not going anywhere or on Table Mountain. Markets over the last month or so now have been saying, we don't believe you. We think they're going to have to go down more quickly. Today, they really went into a frenzy. Okay, so we've now got analysts predicting we might see 4 quarter-point interest rate drops in 2024. So that'd be a full percentage drop by the end of 2024, with the first drops from May next year. That's what the markets are now predicting and what the markets are saying. We have some analysis here that says we think the markets are overreacting. My gut feeling is that markets generally overreact and swing too far the other way. But let's have a look at where we are with swap rates. Okay, if we look at this, 5-year SONIA swap rate, 3.779%. That has come down very quickly. We were just above 4% last week. In fact, you can see on there, 11th of December, blimey, that is 2 days ago. On Monday, we were 4.048%. We're now at 3.779%. We're effectively where we were in terms of swap rates this time last year. And what that means, right, if people are not familiar with what a swap rate is, it's the market expectation, effectively, of where the average interest rate is going to be over the time period. So the 5-year, 3.779 is where they believe the average is going to be over the next 5 years. So it doesn't mean it can't go up from here, but it does mean that people think on average it's going to go down quite a lot from here to get that average. Now, I highlighted this last week, and it's still there. It's still quite interesting to see this. If you have a look at the 5-year current versus the 5-year last year, 12th of December 2022, okay, you can see they're pretty similar. A year ago, 3.737, now 3.779. Okay, so it's kind of come back into parity. If you look at the 15-year, okay, a year ago it's 3.227, now it's 3.626, which is almost zero point 0.4 difference. And in the 30-year, 3.035, now 3.555. Effectively, what this is saying is the markets believe interest rates are going to have to come down quickly over the next couple of years, but long term they're probably going to be going up again, or coming down quickly, but then stabilizing at a higher level. So the market is still saying that we're not going to go much below 3.5%. I've always said my belief is we're going to end up stabilizing between 3.5% and 4% for a persistent interest rate. So effectively, the market seems to be roughly agreeing with that. But let's look at that in a nutshell. Are we going to see rapid interest rates cut next year? And if so, what effect is that going to have on the property market? Because what a lot of people do is go, interest rates down, property up. But it's not as simple as that. We're pricing in these interest rate cuts because the economy is, quite frankly, being ground into the ground right now. And we are still only halfway through feeling the effects of the current interest rate rises up to 5.2%. Okay, so this expectation of interest rate drops is based on us going into recession. Recession, because the housing market is symbiotic to the economy, recession is not good. Now, when we dive into these figures in a sec, I really want to focus on the construction side of it, actually, especially the new build housing. And because effectively, the reason that these are so symbiotic is I think a lot of people don't understand the impact of the property market on the economy as a whole. You think the biggest transactions, or the largest transactions that people make, are property, right? And if people are moving, people are spending lots of money on different things. You're probably going to be spending money on you buy something, you might be extending, you might be refurbing, you might be buying new furniture, might be buying new carpets, curtains, new TVs, electrical goods. Everybody moving house is a reset to go, we're going to spend a lot of money on other stuff rather than just buy a house. We're going to buy a whole load of stuff. There's a whole supply chain. So huge amounts of the UK economy are actually linked to people moving, people buying new houses and moving, and effectively all of that money moving around the system. Right now, we are crunched. We know we're crunched. We know the data is saying that even though we might be thawing slightly at the moment, there's not been a lot of transactions. We're historically low in terms of transactions. Yes, they are picking up, which might also not be a good thing for the property market, by the way. But ultimately, we have seen that stagnation in the property market, which is then obviously going to lead into probably stagnation on a macro level with GDP. So look, anyway, let's go and dive into the actual figures, so we can see what it says. There we go. Let's go on something white so you can actually see me. So we are down 0.3% in October 2023, a fairly large amount. But what I really want to do is focus in on this graph here. Okay, so technical recession is 2 successive quarters of negative growth. Okay, so if you've had Q1 strong growth, then 2 quarters of negative growth, you're in recession. Now we could have quarter of strong growth, 1 quarter of of negative growth and 1 quarter of flat growth, and technically we're not in a recession, even though we might be lower as an endpoint than if we'd had 1 quarter up, 2 quarters down, if that makes sense. So when we look at where we are, we're in October 2023. If you baseline it, okay, and this graph is baselined against 2019, we are at a baseline of 102.4 compared to 2019 being 100. Effectively means right now we are 2.4% bigger than we were in 2019. Yes, we've had COVID, but let's face it, that's not a spectacular amount. If we go to January 23, we're at 102.4 baseline. So October 23, we are exactly the same in terms of the size of the economy than we were in January. So there is no growth. We are completely flatline in 2023 so far, and we've got 2 months to go, November, December. Amazingly, and every time I see a GDP report, it somehow manages to link bad news to the weather. If we can just show that, if I just scroll down to the back, you'll love this. Does it have cross-industry themes? No. Can I find it? There we go. October 23 had exceptionally wet weather, as detailed in the Met Office's October 23 weather report. The report stated this was provisionally the equal 6th wettest October on record for the UK since 1836, okay? And the wet period in October 23 was cited as a negative factor for business, most notably in the construction, retail, pubs and tourism. So it's, I don't know if this is a British thing. What do you think, team? Is it a British thing that if there's bad news, we say it's the weather. I'm in scaffolding, right? I have a scaffolding group. Yes, it was wet. Yes, the lads were still out there working. Okay. Wet weather equals people stay in and buy stuff. Or people go to shopping centres and buy stuff, or go to cinema, right? All this sort of stuff. People generally stay in and buy stuff if they can't get outside. So I'm not sure I buy into this whole wet weather thing. You know, last time it was strong winds. We're always trying to look for some excuse. Anyway, I digress. We can have a chat about the weather later if you want. Let's have a look at the jagged sawtooth. So we've talked about this quite a lot over the last 4 months. This is the monthly jagged sawtooth pattern that we have. If I just take all of those off, I think we can now see, I can't draw a line on this, I'm afraid. I'm on my on my laptop on this screen, so I can be interactive rather than a screenshot. If we draw a line from June 2023, which is where the last sort of peak of the sawtooth was, I think you can see it's fairly obvious that now from July, August, September, October, we are, you know, going into effectively I would say a sliding compression. So this looked to me like a level sort of sawtooth pattern. We're now going into a sliding channel. If you draw a line there, if you draw a line there, a sliding channel down. For me, it looks like we are now on the way down, but we never know. We could be wrong. This could be a one-off, and we could be back off to the races in November. Maybe we have a massive Christmas, massive Christmas surge. Although I saw an article end of last week talking about how people are holding off on their Christmas shopping at the moment. So I'm not convinced November is going to be much better. Look, I don't want to go too much into all these different details. This is a services sector, which apparently was the largest contribution to the negativity, which is obviously in the UK, we are mainly a service-based economy. So of course, any variations in the services is going to affect it more than manufacturing and construction, which are the two second bits. If we look at, don't worry too much about that. I said I don't want to go into the nif naf and triv. I want to give you high level stuff right now. This is the manufacturing index. Again, we're baselined at 100, with 100 being Jan 2022. And the index production, if I can, if we come off, we take all of these off other than the main one, you can see again that, you know, we've been pretty much negative in manufacturing post-COVID. We had a little bump up, which got us back to parity, and then we've been on a gradual decline again. So manufacturing is in the decline. Services have been sawtoothing around, and then we go to, oh, by the way, if we actually look at what is negative and what is in decline in the manufacturing, down at the bottom, we've got manufacturing of machinery and equipment, okay, i.e. creating things that create other things. People are not manufacturing as much stuff, so therefore the demand for manufacturing equipment is down. Manufacturing of computer, electrical and optical products, right? We're making less computers, which means people are working less. Manufacture of base metals and metal products. Again, we're making less metal, less raw materials to make more stuff, right? All of these things are fundamental to, if you're looking as a forward-looking indicator, the fact we're dropping off in terms of manufacturing on these things are quite telling. The one thing that has gone up is the manufacture of transport equipment. I would imagine that is being propped up because of the massive supply shortage we had with the semiconductors end of 2022 into the beginning of 2023, which just meant we couldn't make the amount of vehicles, cars, vans, trucks that we needed to. That obviously led to a surge in pricing for cars, especially second-hand car market. We're now seeing the rapid drops in second-hand car market as more supply is coming in. So that is the one thing really that is pushing manufacturing up. Let's go into construction. Construction is not a pretty picture. So we can see here, let's just take off everything but the composite. So the composite, right, we've kind of eked up past 100 in, May last year, come up a little bit, and now we're on the way down again. Pretty much all of construction, and this is why this overall can be misleading, why we need to understand the component parts of this, right? If we have a look at repairs and maintenance is going through the roof. We're almost seeing an exponential increase in repairs and maintenance, which for me means people are not moving, they're staying at home, and because they're staying in the houses they've got, they're having to, effectively put a bit more into their own houses to repair and maintain. By the way, I don't see this as a good thing, because repairs and maintenance is not new supply. It's not adding value. It's probably because, cost of labor, cost of materials has inflated so much. I would imagine, I know these are real and therefore inflation adjusted, but all of those costs have inflated. People are probably seeing the houses start to crumble because they've not invested in them for a while, and so they're having to put money into repairs and maintenance. But what's really telling is when we look at the new work, right? So new work is kind of now, I would say, starting to capitulate. We are at 92.6. And ignore COVID, right? Ignore that spike down. Clearly, nobody was starting new developments in April 2020. This is new house building. We are 92.6 against a baseline from 2019, which is pre-COVID. So that is almost 10% down in terms of new sites, new construction started since 2019. And as we know, right, we've not been building nearly enough anyway in the, for the last however many years, decades. But that looks to be a bit of a capitulation right now. And clearly, new builds or big developers are not starting their sites right now. Why are they not starting their sites? I would imagine there's a massive increase in materials, massive increase in labour is depressing profit margins for the new build developers. They work on fairly thin margins anyway, the big developers, and with the expectation of property price falls, why would they start work? So effectively, I'd imagine what's going on at the moment. There's a lot of land banking happening for when prices come down, or if they don't come down as property market goes up again in the future, which it will. Some chats on videos earlier this week, I could see from people talking anecdotally about lack of new build sites starting, and I think we're definitely starting. We're seeing that come through in a big way right now. So think about it logically, team. Nobody's building. So nobody's buying. I mean, of course, they're buying old stock. Of course, there's always going to be some people buying, but this is the fallout of the market contracting in terms of sales volumes. Nobody's building, therefore nobody's buying. Nobody's moving, therefore none of that money that would normally go into the economy goes into the economy, right? And we start to see that vicious circle of property market or GDP go down, go into recession, economy's not doing well, people have less money, wages start to suffer, unemployment goes up, people's effectively perception of their wealth goes down, property prices go down, and it all goes cyclical. Okay, so everything we've been talking about is still here. I still find it amazing how there's so many people with that narrative of everything is rosy, we're going to avoid recession, and property prices are going to be spiking up by the end of 2024. I can't really see it. So look, I didn't want to have a long time on this evening. It was just a short one to talk about this. Before I go to questions, as always, my one request for you, if you are new to the channel, or maybe you've been part of the channel and watching the videos for a while and you haven't subscribed, I am on a push right now and a mission. I have a vision to help get realistic data, to help get you the actual crystal ball, or understand what's going on when we look at the data, so you can make more informed decisions. And the one thing I'll ask you, and the one thing I'll ever ask in this channel, is to subscribe to the channel and help me grow it, because when we grow it, I can put more resources into it. Right now, I'm currently looking to bring somebody on board to effectively help me run this channel and act as my right-hand person to research, to produce, to up the ante here, so we can get more out on a more regular basis and take some of the workload off my shoulders. And that's going to benefit more people. And the only way we can do it is to grow the channel. So please do subscribe to the channel. Right, let's go for it and see what the questions are. Give me a thumbs up if there was some value in going through this economy. What do you think, by the way? What do you think we are going to go through over the next 2 months? Do you think Q4 2023 is going to be positive? Are we going to flatline, or are we going to be negative? Do you feel we're going to be going into recession? I thought what was really interesting, I found a quote from Capital Economics, where they're now saying, and literally this, in fact, I want to find it. That's really terrible English. I want to find it because it was such a funny soundbite. Where did I see it? If I can't find it, I can't find it. It may have been on here. Yeah, I can't find it, but it was a release by Capital Economics research, who said we might enter the tiniest, smallest recession, which I thought was amazing language for an economics research companies come out with words like the tiniest, smallest of recessions, which to me sounds like a backtrack, right? Because they've been saying we're not going to enter recession. Everybody's been saying we're not going to enter recession in terms of the mainstream. Everyone's saying we're resilient, we're going to avoid it. 2024, we're going to be back to growth. It's difficult to argue against that objective data. Okay, let's see what we've got in terms of questions. Mark, hi, O for longer. There were all the signs of their contraction wasn't in Hunt and Sunak scripts. It definitely was not. And of course, tomorrow, team, is MPC meeting, right? So we've got Bailey and Co. Meeting tomorrow. I still understand that they're kind of split 6-3 in terms of 6 keeping it level, 3 still wanting to up it. There's still some calls for a 0.25% up. And look, we're in this funny situation right now, aren't we? Inflation is still systemically sticky. I'll be very interested to see the next print, which I believe is out on the 20th of December. So when's that? A week today, I think, is the next inflation print, especially that core inflation, but the owner-occupier housing costs the housing costs when you strip out utilities. That's going to be interesting to see. It'll be interesting to see if we tick up a little bit this month or if it comes down again. But we're stuck in this funny place where we've got systemic inflation, but the economy, it really feels like it's creaking right now. It really does. So where do we go with it? Do we have to take the brakes off and reduce interest rates to stop us going into full economic meltdown? But if we do that, what will be the follow-on effects for inflation over a longer term time period if we haven't got rid of it? Okay. Stafford, I didn't think they would drop interest rates early in 24. Maybe dead GDP will inspire them. Thanks for that, Stafford. Yeah, I've got to be honest. I've always thought they probably would do it in 2024. I thought back end of 2024, we'd probably start to see rate drops. Because when you look at the inflation data for the last 12 months, we've got this next quarter, I believe, of stickiness. Then it will drop off quite quickly unless we have systemic month-on-month inflation from March, April, sort of onwards next year. And when you see that rapid drop-off, we've said it for people who've been watching these lives and contributing to these lives for a while. We've said it for a long time that the battle is not 10 to 5% inflation. The battle is 4 to 2%, right? That's the thing that's going to take 2 years, potentially 2 years to get down. So it's going to be so interesting to see what happens next. I've said so much. Q1 2024, I think is going to be a pivotal point about where we're going to be going. So pivotal. Right, let's see what else we got. Neil, let's put this on. The big question mark is how student debt impact property prices. Interesting. The junior at work has 80k student, and she says she's far from the worst indebted. How will the next generation afford homes? Yeah, look, Neil, I think this is a really interesting discussion point in terms of longer term impact on property market. Because last week we talked about how many people are now taking out 35, 40 year plus mortgages. I'm going to do some research on this and go, right, what's the difference in terms of interest paid from a 25 year to a 40 year mortgage? All of that money, all of that extra interest that's being paid on that mortgage now to take out that longer term mortgage so you can afford a mortgage to buy a property, that is all money that's not going to go into other places. That's all money that's not going to go into pensions. It's money that's not going to go into savings. It's money that's not going to go into investments. Same with this indebtedness, right? People coming out of university, 80k debt is horrific, isn't it? It's changed a lot since I went to university in 99. How's that going to affect everything? We are a country burdened by debt, clearly, and it's probably getting worse. Neely, good to see you on. Neely, sticking with Table Mountain theory with slight gentle downward slope. The banks are literally unchanged in what they offer in 1 year fixed savings. All investors should adjust to an interest rate long term somewhere between 2 and 4%. That's what Howard Mark said in his Sea Change memorandum. He's a very smart guy. Yeah, look, I'm just going to put that on because I agree entirely, as always, with Neely. I would say, I actually think it could be, my thoughts are between 3 and 4% is where it's going to settle long term. So you said 2 and 4. I feel 2 to 2.5 feels low for where we are. I think 3 to 4% is probably healthy. And when you're looking, so let's just divert this back to talking about property, for example. We've had effectively a 40-year bull run in assets. due to global interest rates declining. And when you look at the 40-year chart of global interest rates, it's declined pretty much consistently. Yes, of course, we're going to have small little events like 2008 or, stuff like that, which causes, deviations. Nothing goes down in a straight line, nothing goes up in a straight line. But the general pattern for 40 years has been decline in global interest rates, which of course has caused a massive passive asset boom for the, I say this in no sort of derogatory term, the baby boomer generation who have benefited from that 40-year asset boom. I don't feel that is how we're going to be going forward for the next 40 years. I think we'll probably see, we might have to see, and this looks what the markets are pricing in, short-term cutting interest rates to save the economy, and then probably either leveling off or, creeping up again long-term to get in that 3 to 4% margin. But this is no bad thing for people who are professionals, right? Who are active property investors, active property traders, active property developers. When you price this into your figures, it's just a cost of doing business, right? And when you price it correctly, you buy things correctly. This is why property prices will correct or are correcting, even if it's only in real terms, because all of this now gets costed in to people who know what they're doing, buying things at the right price. And an equilibrium will be found eventually, and therefore those who understand how to force value appreciation, understand how to cash flow and yield an asset, will do just fine. Not just fine, they'll do brilliantly, right? Certainly accumulating over the next few years as the panic sets in. This is where people accumulate and then benefit from the next cycle up. But interest rates should never have been as low as they were for as long as they were, and it artificially props things up on cheap debt. Of course, the moment debt is not cheap, everything starts creaking, which is what we're seeing right now, which is why I struggle to see with the interest rates, as they are, how we can't. I say how we can't. Of course, we can always defy logic, but logic dictates we should go into some form of recession, okay? And there should be some pullback. That's the whole point of putting interest rates up. If it carries on going up, there's some weird bubble going on that's probably artificially stimulated from somewhere else. That's not healthy, right? We want healthiness. Cool. So thanks for that, Neely. I very much respect your comments. Mark, 2023 has probably had the most interesting thing to comment on. You're right. I totally agree. We have seen a spike in insolvencies in business. However, we are starting from a low base. So it's not like everything's in meltdown, but the trend is up. We cannot deny that the trend of business insolvencies is going up. And I'd imagine there's a lot of businesses with a lot of variable rate debt out there who are struggling. Exactly as I said, right? When the tide goes in, we see who's been swimming naked. Sean, good evening to you. Neil, I work with a company who are non-stop designing and preparing planning applications for house builders, never busier. I'd love to see, the data. I know that's a good anecdotal thing. By the way, preparing planning applications could well be for 2-3 years in the future. All right, doesn't mean they're going to be starting to build right now. I would imagine right now we've got a lot of land banking going on, people sitting on their hands, seeing what goes on. You want to get your planning in. They're probably busy doing planning applications, and if they are, because they're probably not building as much. TJWB99, is it a good time to buy if new builder developers are not building and people are staying out and not selling? Surely the shortage supply is going to push prices higher. Let me put that on. I'm going to answer this and then I'm going to close off because I only want to do 15-20 minutes. But of course we are half an hour in. This is a great question, right? And the question is, the answer is, if you don't mind me calling you TJ, it depends. So I personally think it's a fantastic time to buy the right property at the right price that's going to give you the right amount of cash flow if you are an investor, okay? The reason I say that is, as people who watch this regularly know, my personal focus right now is on buying mixed use or commercial property at very depressed prices and arbitraging that into residential rates, or finding inherent defects, so, for example, low leases, low tenancies, where we can do lease negotiations or shuffle paper around and force appreciation very quickly. And we're seeing a lot of opportunity, or I'm seeing a lot of opportunity in that space to be able to buy property at a depressed price from baby boomer landlords exiting, institutions, people who don't really know what they're doing, and forcing the appreciation and then effectively getting a very high return on capital by recycling funds with high cash flow to cater for the high interest rates. For me, amazing opportunity. If you are interested in understanding how to do that, I do have a white paper, robstewartglobal.com/white-paper, which you can download for free. It explains some of the strategies to do that. Please feel free to get that. It's a 30-minute read. It gives you some sort of idea on how that works. By the way, I've just decided today that I will be writing in my second book, and it's going to be basically a much longer form version of this to kind of walk you through how to do it with these sorts of properties. So for me, fantastic time to buy, but there's lots of things I would not be buying right now. So I would not be buying anything to flip. I would not be buying anything to develop out right now, because I think it's just too risky. If I was buying something to develop as a developer, I would be pricing the land I'm buying so aggressively to have the margins in for a 10, 15, 20% price reduction. But I think what a lot of people fail to understand in the development world is it's not even necessarily about the price of the property you're selling. It's about the length of time it takes you to sell it if you're carrying development finance, right? If you're doing stuff in cash, it's a totally different kettle of fish. If you are taking out development finance, bridging finance, joint venture finance with debt, right? If you model a development for, purchase, build, sell for 12 months, and you hit the market wrong and it takes you 18 to 24 months to exit, that 6 to 12 months worth of carrying costs of what could be a very expensive loan could put you under. So it's not even about the property price, it's about the speed of selling. Now, that's as a investor or developer. As a home buyer, for me, it's a very different equation, because as a home buyer, you're not looking to leverage property to make money. You should never be looking to leverage property to make money as a home buyer. You should be buying a property for your home. And if you are buying for the long term, if you're buying a forever house and you don't intend on moving, I'd imagine there's probably some pretty good deals out there right now that you can negotiate. But it's not about making money. Buying your house should not be seen as a store of wealth, because when you actually compare it to inflation link it, and then add all the costs of owning that house, it's not a store of wealth. Okay, it's actually it's a pretty poor store of wealth, almost a liability. This is why I live in rental and I put all my money into growing my own portfolio, because in rental I can live here. Yes, the rents have gone up a fair amount over the last couple of years, but there's flexibility. I can live where I want. If I don't like it, I can move. I don't have to pay tens of thousands of pounds worth of stamp duty every time I want to move house. Boiler goes, landlord, landlady fixes it for us. And then when you do the figures, if you take that money, invest it in momentum investing, you're going to make a huge amount more over that, the same period, by putting your money into assets that you can recycle your cash and generate cash flow. So that's how I do it. I've done that for a long time. The only time I've owned my own house in the last decade is when I built it, lived in it for a few years, and then sold it for a decent profit just before. Well, I sold it in January this year, so I'd rather be lucky than good in terms of market timing any day. So I don't know if that answers your question, TJ, about whether it's a good time to buy. If it's a home, there is, I think, no bad time if you're going to be living somewhere for a long time. But please don't see a home as a store of wealth. Okay, Stafford's right. Thames Water can't service their debt. All right, team, I'm going to leave it there for the evening. I'm up to Chester tomorrow, so I'm going to miss the opportunity to do a live after Bank of England's MPC decision tomorrow. I don't think it's going to be that exciting. I think it'll probably be 5.25% business as usual for a while. If there's anything completely different, I might try and get on my phone and do a live. But I don't think there will be, so I'll acknowledge it with a community post. Otherwise, I hope everybody has a good end to the week. A couple of days left. Next week, we're winding up to Christmas, so we can start to chill out a little bit. Oh, sorry, I've got one. Such a sucker. Got one more question from Wazza. Let me put it on. One more, then I'm off. If you had 170k and lived at home, would you advise focusing on building a portfolio in current conditions or get on the ladder? This is not financial advice. I'm not qualified to give you any financial investment advice at all. So I'd just like to clarify that. I would 100% be investing that money. But you've got to know what you're doing with it, because if you put it in the wrong place, you're going to erode your savings. Put it in the right place, you can multiply that fairly quickly and develop a very high cash flow. That's what I would personally do. That's what I am doing with my own funds. And we're about to complete on our second deal of the year, which would be £1.5 million worth of property in 2023 we've purchased, all of which at depressed values that we can add the value very quickly and create a large amount of cash flow on. So I'll leave you with that. Have a great couple of days, team. I will see you on the next live.